Hello, this is Steve Sanangelo of the SRS Rock Report. This is my first YouTube video. I decided it was a good idea to start doing videos because some of the concepts, the analysis, the research on the energy return on investment, how it's going to impact the metals, the economy, our society, and our future. I thought it was a good idea to start using the video platform because it can be better grasped these concepts using pointer graphics and charts. And so I'm going to start doing these hopefully one or two a week. And this first one is going to focus on, it's a short one, I'm going to focus on the bubble economy. And actually some of these charts you may have seen before, but what I've done is a little before and after. And I just want to show how much of a bubble some of these stocks are, some of the economy is in compared to gold and silver. So let's get going. Okay, this is Caterpillar stock. And I first wrote about this in November 8th. And that's when I did this first chart. Now, what's interesting about Caterpillar, it's up actually nearly 3,000% since it started trading, or let's say since it was trading at 275 in 1981. So because it now is trading at 137, it's up nearly 3,000%. Now, what's interesting about Caterpillar, its PE ratio, because its stock price has shot up so much, its price to earnings ratio is now 95. Now, I don't want to get into the details of the price earning ratio, but let's just go by what is normal. The normal PE ratio is 16 for the past 13 years. So it's up 6 times more, Caterpillar. And Caterpillar is a manufacturing company. They produce large earth-moving machines and parts. So to see its PE ratio at 95, we're seeing real bubble territory here. But let's look what happened more recently. Now, when I put this chart together on January 5th, look what happened to the price of Caterpillar. It was here, 137. Now it's shot up to 161. And it's actually a little bit lower. Remember, it was about 4,000%. It's 3,600 because it's comparing it now not to 275, but to 561. See, the prices were fluctuating up and down. It just happened to hit it at 561. So, but that's not the important thing to look at. The important thing to look at here is look how much it's shot up to 161, especially in the last 2 months. Now, because the price has moved up, the PE ratio is 112, which is now 7 times higher than 16. But let me just show you right here, the price of Caterpillar during the good years, which was when the price of oil was over 100. And a lot of the companies were like copper producers, gold producers, mining companies were adding more equipment because they were getting a lot of money. The stock price didn't get above 100. When the oil price crashed, a lot of companies cut back on their capital expenditures. Look what happened. It fell in half. Now it's not 3 times, but it's close. So Caterpillar is really in bubble territory. Now this next stock is JP Morgan. It's my favorite bubble bank stock. It's the largest U.S. bank, commercial bank. And its price is up 3,933%. As of November 8th, it was trading at $101. Back in 1983, it was $250. So let's see what's going on with JP Morgan now. Not up like Caterpillar, but look at it, it's gone even higher. It's at $108, and it's now at 4,200% higher. But again, if we look at the peak here, it was $38 before the tech boom crash, and then we had $40 at the peak before the 2008 crash, fell in half to 18. Now look what we have. It's shot up to here. JP Morgan is definitely a bubble stock. Now, this is the Dow Jones. It was at this point in time, November 3rd last year, it was at 23,500, up 2,547%. Let's take a look at now. It's shot up even more. It was right here. Now it's up to 25,295, but that was January 5th. Today it's 25,400. So the Dow Jones was trading at 850 in 81. It's now 2,570% higher. But I want to show you this. Before the the crash in 2000, 99, 2000. It got to 11,500. It fell 4,000 points. Recovered, it hit about 14,000. It fell in half this time. See, it's coming back to that 7,000 range. Now, what's interesting, when it started to increase again, this time it went to 18,000, and then we see a little fall. This is 2,000 points. Now, what's fascinating about this part right here, and I've discussed this several times, during this quarter, there's only been 2 quarters during the data that retail investors were fearful enough to move into gold in such a way that it pushed the flows into gold ETFs to record numbers. There was only 2 quarters. It was this one, and in this quarter, it was 350 tons. Normal is like, let's say 50 to 70 tons. That's normal. It could be even less. Sometimes it's like 30 tons. This quarter, 350 tons. That meant a lot of gold retail investors were getting into gold. Now, the only other quarter was this one, right when the Dow Jones was falling to its lows in the first quarter of 2009. There was 465 tons of gold moving into the gold ETFs because there was so much fear. But again, if we look at this on a 2,000 point correction, we had 350 tons. And during the lows of the crash, we had 465. What happens when this market finally cracks? And I believe the stock market is at least 35 to 50% overvalued without considering energy production declines. If we add energy production declines in the future, then it just continues to fall. So what happens when the stock market gets down from here to 1,500 or less? What kind of gold demand are we going to see? I think we're going to see record gold demand. Now, talking about a bubble stock, we have Amazon. Everybody knows Amazon. You know their stock price. You hear about the stock price on the financial networks. Also, most people have purchased from Amazon online. Now, Amazon was only trading at $1.50 when it started in 1997. It's now $1,230 as of January 5th. That means its stock price it's crypto. It's gone up crypto percentages. It's gone up 82,000% in 20 years. Well, look at Amazon's PE ratio at 312. If we thought Caterpillar at 112 was high, look at Amazon. It's at 312. It's almost 3 times higher. Now, people think, well, why would investors buy the stock that much to push its price to earnings? By pushing the stock up this high, this is why it has this price to earnings. Now, Walmart is also a retailer, but it's not it is a big online retailer, but most of its sales are in its stores. Its PE ratio is 27. So you would think if Amazon has a 312 PE ratio, that it must be doing much better than Walmart. But let's take a look. Let's first look at Walmart's price chart. Walmart isn't as much of a bubble as these other stocks. We see a move up, we see a consolidation, we see a move up, then we see a consolidation. So it's a bit more subtle, but still it's shot up to $100. And it was only, if you were smart and purchased Walmart in 1981 for 18 cents, it's up 67,000% since 1981. But the interesting thing to know about Walmart's PE ratio, which is not that high compared to others, of 27, it's still almost double of its PE ratio of 15, which was the average for 5 years. So even Walmart is seeing a very high PE ratio. It's not normal, much higher than the average. Now, to compare, as I mentioned, to compare Walmart to Amazon, if Amazon has such a higher PE ratio, price to earnings, the investors must mean that Amazon is doing much better. Well, let's take a look at the financial statements. Amazon, this is the third quarter results. Right here is total sales. Now, last year, they had $92.2 billion. Then they purchased Whole Foods and a few other companies. Their total sales jumped 25% to $117.4 billion. So look at that. That's a huge increase. So that's got to impact their net income, their profits, right? Well, if we go down to 2016, their net income was $1.6 billion. This year, it's less. It's 1.2 billion. So what is fascinating, Amazon's net income, you take that number and divide it by their revenue, you get 1%. That's not a lot of wiggle room. Now, we all know that supermarkets, big chains, they make a very small fraction of money on a whole bunch of sales. Well, we see that right here, 1%. There's not a lot of wiggle room in their profits. Now, why would they have such a high PE ratio, 312? Well, let's look at Walmart. Now, Walmart's newest quarter is on the left side. What we see here at Walmart is they make 3 times the amount of revenue that Amazon, 364 billion compared to 117. Actually, I'm sorry, it's about 2.5 times. Let's say wait a second, it is about 3 times. 3 times or so. Yeah, it's about 3 times. Regardless, it's up about 2.6% since last year, which is 354 billion. Now, Walmart, like Amazon, they're making less money this year compared to last year. It was 9.8 billion in net income. Now they're only making 7.6 billion. But what we see, Walmart is actually, if we divide this number by their sales, Walmart is making 2% net income. They're making double the income, even though they have all the stores, all these employees, all the high costs of maintaining all this. They're not an internet store. They are a real store. They're making more money than Amazon, but their price to earnings ratio is lower. Again, a lower price to earnings ratio is a more realistic number. And so to see that Amazon has 10 times, 11 times higher PE ratio, it's a bubble stock. Now, getting back to the gold, the metals, what we'll find interesting here, back in 1981, because gold was coming off of its highs of $800, it was trading at about $500 in 1981. Well, if we compare it to what it's trading at today, gold is only up 158%. Now, if we go by its peak of $1,800 and divide it by the 500, we only get 265%. Now, if we take it one step further and we say, all right, let's look at the price of gold between 81 and 2000, its average was 350. And we divide it by the peak. Even at that, it's only 420% higher. Now, if we go by this, it's much less. So gold is really not in a bubble. And I can tell you why it's not in a bubble. I've explained this several times, and a lot of people still don't understand, and I think it's just going to take more information and data. But I no longer look at the price of goods, let's say metals, energy, commodities. Their price is mostly based on their cost of production. Supply and demand only impact the price up or down off that supply or off that production cost curve. So let's say one year there's a corn crop failure. Well, the price of corn is going to shoot up, but it won't shoot up for 10, 15 years. It'll shoot up for a couple of months, maybe a quarter, and then it'll come down. But if you look at the price of corn over 100 years, what it cost to produce corn and what it was sold for, average it out, was the overwhelming factor in determining the price. Now, homestake, I looked. Homestake mining was the USA's largest gold mine for quite a long time, for the 1900s to, let's say, 1970s. They produced the most gold. Now, in 1971, and I looked at their statistics in their financial reports. It took about $42 to produce an ounce of gold in 1971, but the market price was $40.80. So they lost a little more than $1. Not much, but they lost money. Now, during the 70s inflationary period, we could see that as the price of oil moved up, it impacted costs of producing everything. So by 1979, homestake it was $247 to produce an ounce of gold. Now, this impacted the market price, which was $306. Even though they're making profits here, they could not sell gold at $40 because they would have lost over $200 an ounce. So no gold mining company is going to do that. So as the price of the cost to produce gold increased, so must the market price. Now, this was also true recently, and many of you have seen this chart. If you haven't, the production cost of Barrick and Newmont, which are the two largest gold producers in the world, are in orange, and the market price is in these green cash little bars. As we can see, as the price to produce gold moved up for these two miners, so did the market price. Here, kind of like in Homestake's example, as the price really shot up, there was more profits. However, when I looked at the capital costs, the capital expenditures, which are not included in the net income, which this is based upon adjusted income, net income, they didn't make a lot of money. So as the market price fell, as the production cost fell, so did the market price. And we could see it's getting closer in 2015 and in 2016. And so now we never see the price of gold go below its cost of production. And this was also true with Homestake, except for 71. I looked at all the other years. They were making money all the other years, and they didn't lose much money here. So plainly, we could see that it is the cost of production that is the leading indicator for the price of most things. Now, this is my favorite chart. Why is this my favorite chart? Because silver is the underdog. I've always liked the underdog. I got a soft spot for the underdog. And silver is the poor man's gold. Now, if we think gold going up 158% in 36 years is bad, look at silver. It's up 28%. Now, it fluctuates because at this point in time in the chart, the price of silver in 1981 was $12. And you can see it fell to 6, shot back up to 14. And I'll discuss why that happened in a different video. But it fell to 6, came to 14, and it fluctuated. But even if we go by the peak of silver, which was reached again in May of 2011, and we divide it by 12, it's still only up 300%. And then if we take the average here, which was $5 for 20 years right in here, and divide it by the current price, it's still only up 244%. So clearly we could see, compared to the Dow Jones, which is up 2,500%, JP Morgan is up 4,000%, Caterpillar is up 4,000%, Amazon is up 80,000%. The metals are not the bubble. The metals are not a bubble. And I don't see their prices falling because of the cost of production is the baseline. Now, I always have to talk about energy because, as everyone knows who reads my work or follows me on YouTube, that energy is the number one important indicator. Without energy, we don't have an economy. And as I mentioned before, the energy industry is different than the auto industry, the healthcare, the retail markets, the tech stocks, because without energy, you don't have any other sectors. You don't have any other industries. So it's important to focus on the energy. Now, what this stock is, it's the XOP. It's the largest SPDR's oil and gas ETF. I think it's like market cap is 2.5 billion. Now, this is basically a lot of it's shale oil and gas companies. Now, the stock price is shown in orange, and the oil price here, which is the U.S. West Texas oil price, is shown in the black line. What you'll notice is that as the price of oil fell, so it also impacted the stock price. And it actually trended pretty well. And as the oil price bottomed in 2016 and recovered, so did the share price of the XOP. But something happened in 2017. Now, what happened? As the price fell and recovered, look what happened here. We have a disconnect. The stock of the ETF of the U.S. oil and gas, XOP, is underperforming the oil price, because in the beginning of 2015, I say right here, the XOP was trading higher at 40. It was trading when the price of oil was at 50, the stock price was at 40. Now the oil price is at $11 higher. It's actually $14 higher today, but at this point it was $11 higher. Look at the stock price is almost $2 less than what it was in the beginning of 2017. Now, why is that? Why is it underperforming? Well, I'll show you why. Art Berman he designed this chart, and he was working, and he still works in the oil industry. He's got his own website called artberman.com, and he's been following the U.S. oil industry, the shale industry, and he doesn't see it being a long-term sustainable industry. It's basically, he calls the U.S. shale oil and gas industry a retirement party. It's over. It's the last thing before you retire. Now, this is exactly the reason why we're seeing the stock price underperform, because this here is a bunch of shale oil and gas companies. And as we can see, 2/3 of them, almost 3/4, aren't making money. They're losing money. Now, two, which is EOG and Occidental, they're actually about breaking even. And then we've got some companies here that are making money. Now, even though they're making money, they're not making a lot of money. And if they're paying dividends, which, like for Chevron's case, they're paying dividends, it still could be like a break even. So this is precisely the reason why. And if we average all of these companies together, which I've stated many times over and over, that the industry is losing money as a whole. Even though some are making money, most aren't. When you net it all out, it's a loss. So that's the reason why the stock price of these energy companies are underperforming the oil price. And this is right here, the first 3 quarters of 2017. Now, the second to the last chart is what I call a real bubble. And I think I'm going to get some negative feedback on this, but I hate to go again, be the party pooper of the cryptocurrency enthusiasts and investors. Listen, you want to invest in cryptocurrencies? I have no problem with that. If you're good at getting in and out, making money, hey, that's great. Do that. However, if we look at this chart, if we thought that JP Morgan going up 4,000% in 30 years and the Dow Jones being up 2,500% in 36 years, and even Amazon at 80,000% in 20 years, Bitcoin has gone up nearly 7,000% in 3 years. It beats everybody. So it's a bubble because I'll show you the reason I believe it's a bubble. And this is just one metric. There are other things that I think that I know that the cryptos are in a bubble, but this is one of them. Now, when I did this chart, Bitcoin was trading at $1,700, and that was just a few days ago. Now it's trading at $1,400, $1,300. So just the volatility is not conducive of something that price that moves that much is just not conducive of something that's long lasting and stable. Well, according to the best analysis, the Bitcoin cost of the miners to solve these equations to make a Bitcoin, it's $3,500. At the time of 1,700, the profit was $1,350. Now, let's say it's trading at $1,400, then it would be $10,500. That's a lot of profit. That's just way too much profit. Now, let's compare it to gold, which is trading at $1,320. According to my analysis, gold's break even is $1,150. Now, because of the oil prices increasing, it's pushing up the cost too, because you just have to move a lot of ore to get gold. And the higher the cost to move that ore, the more it's going to impact the bottom line. Either way, $1,150 or $1,200, you could see it's a sliver of profit. And according to this, it's $170. It'd be $120 if it was $1,200. So this isn't a bubble. This is the bubble here. And again, this is just what I look at the cost of production. So going forward, I'm going to put out more videos on why I see the oil price falling, how it's going to change the cost of, it's going to disconnect from the gold and silver price, how the energy return on investment is going to impact the precious metals, the overall economy, and different factors and different things I'd like to put in these videos. So I appreciate you checking out my first video. Please consider subscribing to my YouTube channel, the SRS Rock Report YouTube channel. And again, as I mentioned before, I plan on putting out 1 or 2 videos a week. So if you like this video, please let your other websites know about it, or friends and family. And I do appreciate your time. And this is the SRS Rock Report signing off.